Breaking the Mold, Alternative Finance, a remedy to the sector's capital woes. That's what our panel is going to be discussing threadbare. Our moderator for this next panel is again someone you've already met. Please welcome once again Mr. Ramesh Nair, MRICS COO, Business and International Director, JLL India, and member, RICS Global Regulatory Board. The first member of this panel is an executive director at Morgan Stanley Real Estate Investing in Mumbai. He joined Morgan Stanley and has spent a number of years in their New York office underwriting transactions in opportunistic and core real estate. He has prior experience in strategy consulting and an MBA from the University of Chicago. Please welcome Mr. Vineet Seksaria, MRICS Executive Director, Morgan Stanley Real Estate Investing. Our next panelist has more than 25 years of industry experience across banking, investment management, and the financial services sector. He has held varied responsibilities, which include heading equity research, managing equity portfolios, heading the equities business, managing alternative assets, and leading the PMS business. Please welcome Mr. Shehzad Madan, MRICS Head, PMS and Alternative Assets, Reliance Capital Asset Management Limited. With over 20 years of business experience, including over 15 years in the real estate industry in India, our next panelist started at Sun Area in early 2006 as a principal responsible for sourcing, identification, acquisition, management, and disposition of real estate investments in India. In the last few years, he has handled investments in various property types, including IT and ITES, SEZ, commercial, residential township, retail, hospitality, and warehousing. Here he is, Mr. Saurabh Jain, MRICS Executive Director, Sun Area Property Partners. The next member of this panel has 15 years of work experience and has been with the Kotak Group. He joined KIAL in 2007. Prior to joining, he was with Kotak Investment Banking, where he was a Senior Vice President heading the real estate and energy sector verticals. Please welcome Mr. Vikas Chimakurti, Director, Kotak Realty Fund. The next panelist has over 2 decades of diversified experience in Indian real estate. Over the last decade, he has successfully done, managed, and exited multiple investments in private equity and mezzanine finance through the FDI route. Prior to this, he has been involved in consulting an agency right from the inception of international property consultants in India. Please welcome Mr. Puneet Bhatia, MRICS member, CapitEdge India Investment Advisory Company Private Limited. Joining the panel now is a senior advisor to Clearwater Capital Partners, a Pan-Asian special situations fund, and former managing director and CEO of Altico Capital, a real estate credit platform co-owned by Clearwater and other strategic global fund houses. He joined Clearwater and was a member of the firm's management committee. Based in Mumbai, he was responsible for Clearwater's Indian investments for close to a decade, including overseeing the asset management team, and is involved with extensive corporate finance and equity monetization strategies. I give you Mr. Karthik Atreya, Senior Advisor, Clearwater Capital Partners, and former MD and CEO, Altico Capital. The final member of this panel has over 20 years of experience in financial services and real estate industries. He joined Red Fort and has expertise in acquisitions, legal, asset management, and operations, including all CFO functions. Prior to Rising Straits Capital and Red Fort, he spent 10 years with GE Capital in India, Europe, and the US. Please welcome Mr. Kalyan Chakraborty, MRICS Managing Director, Rising Straits Capital. With that, I hand the floor over to Mr. Nair, who will take us through the next 50 minutes.
Good afternoon, friends. Welcome to this unique interactive panel discussion. We have the who's who of the fund management industry in the country here in our panel. Let me start with you, because when we meet a developer, he says there's no money in the system. But we meet a fund, he says there's only money in the system. So where's the disconnect?
Hello? Hello? Yeah. I think what you're saying is the fact there is actually no disconnect. The capital, there is a lot of capital available with the fund managers at this point of time, more on the debt side. Uh, but the capital is chasing a fewer set of developers. So you have a certain tier of developers who have no dearth of liquidity available, but now the way the market is because of fall in sales and all that, the market itself is distinguishing between tier 1 and tier 2 developers. With the tier 2 developers facing challenges, the funds are also not going ahead and giving capital to those developers. So there is actually too much of liquidity chasing certain set of developers and practically no liquidity for certain set of developers.
Because today, in the keynote speech, Niranjan mentioned that the bigger you are, the fall could be mightier. So, what's your take on that? Because funds are always looking at tier 1 names. What happens to those smart, medium-sized developers who will miss out on good growth capital?
So if we were to look at our performance and our track record, we have always made money with mid-size developers, with large developers, really big ones. Your ability to make money is not that high. So our experience has actually been good with more mid-tier and not the one or two big names. They never allow investors to make money. Let me put it in this way.
Shasa, do you agree with Vikas?
Yeah, broadly, what I would add is that there's more money than ever out there in the market. I don't think there's ever been so much money, so to speak, other than maybe 2007, 2008, or 2006, 2007. Look at the numbers for a lot of AIF funds which are out there. They've not even been able to deploy 50% of the capital. Over and above that, you've got money coming in from offshore, you've got new sources of money, you've got NBFCs. Almost everyone you know is doing funding to developers. So there's a lot of money available in the system. And my sense is, even while what Vikas said regarding large developers is completely accurate, that a lot of people gravitating one towards a certain category of developers, two towards certain geographies. But there's almost, to my mind, no one with a half sensible project who sooner or later, with enough song and dance, who hasn't got funding. So sooner or later, almost everyone gets it. So there's enough money available. I think the way the deal needs to be put together is which makes sense, a lot of sense, of course, for the developer, but also for the investment managers. So money is not an issue at all.
Kalyan, coming back to the disconnect part, Shasa just said there's so much of money available. But again, most tier 2, tier 3 developers are struggling to get money. Even many tier 1 developers today are still borrowing at high rates. So where's the disconnect? Kalyan, after Kalyan.
It's already on. Sorry. I do not know whether I totally agree about the disconnect being present in the first place, to be honest. I think the fact that there is a lot of money is true. The fact that some developers are struggling is also true. But two ways of looking at it. It is not necessary that everybody who is looking for money will get money. There are factors which an investor keeps in mind while giving money. And many a times those factors are things the developers are struggling to qualify on. So yes, the tier 1 developer effectively with respect to the track record that the developer has had in the past of having successfully completed his projects, of a higher promise to keep ratio in his projects in the past, they will always get an attention. To me, tier 1 is not about how many projects have you done in the last 20 years or how many square foots have you developed, but how many times have you managed to keep the promise that you made. The biggest problem that is plaguing us today, right now, is about that, is about delivery. To the extent that one gets a confidence that this particular developer, irrespective of how large he is or how large the project is or what is the demand of the quantum of money that particular developer is seeking from us, as long as he ticks the right box, we are game to looking at him. So I think the disconnect is, as long as the quality of the developer, quality of the project is good, good quality money is coming his way.
Vineet, you agree with that?
Hello. Yeah. So, actually, I'll start by first addressing the first question you asked. I mean, capital like ours has partly withdrawn from the market because there's so much other capital available, frankly, which answers to your first question to some extent, right? Because, frankly, because of so much capital being available, the rates have come down for the right people, and for funds like ours, it just doesn't meet the absolute return threshold. So, this whole structured finance business has become kind of, largely a business funded by domestic or very long-term sovereign type of sources. It's not really a business for opportunistic funds like us. Um, so that's one, but at the same time, we also feel that the risk associated with these projects hasn't come down dramatically, right? So while you see the returns coming down, the risk associated with residential development anywhere in India has not come down in the last 3-4 years. Approvals haven't gotten easier. It's much harder to underwrite projects because sales have gotten much, much slower. So, it's not like the inherent risk has come down, but the rewards have come down. So, for funds like ours, it's become very, very tricky to deploy money, frankly. So, to answer your question on whether it's, uh, look, I mean, at least for people like us, we will de facto go to the guys who've done and proven themselves, right? I mean, we don't have a ton of appetite to back entrepreneurs in real estate or kind of small or even medium-sized guys. So I think, that's just because of our DNA and because of what we like to do. So I think, for us, it becomes difficult to finance things other than that.
Karthik, you want to add to that?
Yeah, I think my panelists covered most of the stuff, but just to say it and give it a little bit of a different color, I think, is there enough capital in the market? It depends on who you ask, both on the developer side as well as the investor side. And can he access that opportunity? Again, as Vineet said, the larger and more institutional you are, the harder and difficult it becomes for you to access opportunities, that are perhaps fairly attractive, as Vikas said. So I'd like to bring, I think the rest of the points were made fairly well by my colleagues. The only other point I would like to bring between tier 1, tier 2, and we have wonderful representatives of the builder community in this audience. Frankly speaking, I feel the real estate community really is a bellwether for the sort of lifestyle quotient and the wellness quotient in this country. So if you see, whether Arjit, Sonu Nigam, all these guys still perform for builder events as opposed to others. So I think in a sense they deliver a lot of the perception on how the market's doing. And as an investor, my own thinking in the early days, and we are fairly new to real estate in the last 3 years, but we've built a pretty decent book, has always been about realizing and understanding that the underlying credit quality, in a sense, mostly remains the same. And so, the difference comes in terms of how you perceive somebody can actually build out a project and deliver on it. And there have been people who funded, tier 1 developers who are still not got their capital back. And there are people who are mid-sized, not very well known, but who've delivered extraordinary returns. So I think it's all about underwriting and the ability to identify and originate transactions. So I think this is one of the most exciting markets in summary. I think, considering the macro liquidity constraints, and real estate represents a very tangible, sizable opportunity for people to lock into real estate, real assets and cash flows.
Saurabh, with so much of money available, still buyers are not coming. You ask any developer, he says, I'm doing okay, but he doesn't tell you the true picture. But you know what's the true picture because you are a financial partner with a developer. What's the real situation in the country from a residential point of view? You can throw some light on which are those markets doing well, which are those asset classes doing well. It will be interesting for the audience.
So given our experience and what we are seeing right now, it's very selective. It's not easy to paint the market with the same brush. It's selective by developer, it's selective by city, it's selective by location, and most important, selective by product. And that's the differentiation which we are seeing in this market. So when we talk about residential, everybody knows that NCR is slowed down, Bombay is slow, Bangalore certain categories are not selling, but it's also moved to from a pull product to a push product on a residential, and that is a big change which you're seeing in the market. If a developer is waiting for customers to come to his office and adopt the same methods of selling, it's not working out. So for those developers, sales are slow, they're in a liquidity crisis. But the other segment of developers which believe in operational efficiencies, who are pushing their sales team, coming out with innovative marketing and advertising campaigns, treating the customers well, and saying that we need to make sales and we need to garner confidence of customers in this market by executing the project and delivering what we have promised. Those developers are doing fantastically well, and they are not seeing any issues of sales at all. So, you know, if you take the best thing is the data available is some of the listed developers. You'll see that some of the listed developers have had record sales in 2015. And certain other listed developers have had the worst year's performance. So that segmentation is happening because they realize builders who want to change to the changing times will do well. And as they say, as PB Shelley said, old order changeth, and it'll keep on changing. The top 10 developers of last 10 years, and you see the top 10 developers of this decade, it's completely changed, and they will not be the same developers in next decade to come. So what you have to realize is what is your own potential, where you want to take your organization. Market cycles are going to be excuses. You have to build operational efficiencies and keep selling. So that's on Resi front. Office, I'm a little skeptical right now because I'm seeing so much of optimism in office segment, and which is scaring me because this has happened in 2006, 2008, when so much of capital came into office segment, and you had a situation where everybody said that the demand is growing by 20%, is going to touch 50 million, 60 million, 70 million, 80 million, and you need to put more capital, and guess what? We raised large funds, so many people raised large funds, and big money came in the office segment. Oversupply of capital, demand crushed, and you had a situation from 2008 to 2014, office buildings were getting converted to residential building. Now I hear, and proposals come to me, residential is being converted into office. Where? Dahisar. There's a residential project, developer wants to convert residential into commercial. That's scaring me now. It's already started to build that skepticism in this market. So I think asset class depends. Office it's an operating asset. Some developers have realized that and recognized that, and they will only build if they have the capabilities and organization set up to deliver those kind of operating assets. So that's our outlook.
Puneet, what's your take on the market? What's the reality?
See, I think, if you look at today's market, I think the biggest challenge which we face is in the underwriting is essentially the sales absorption. While I feel that there could be certain, silver lining in the curve where few developers may have shown a better sales velocity, but generally, if you look at it, when you underwrite a transaction, you could still have a certain, idea about how would the price movement would actually happen, because look at the past trend. But if you look at last year's absorption and on that basis try to paint a picture for the next year or two, it's very difficult, and probably you will not be able to close the transaction also if you purely look at on the data perspective. Having said that, I think there's a lot of maturing of the market over the last decade or so since we had the first FDI deal. We were lucky enough in an earlier organization where we did mezzanine finance way back through compulsory convertible debentures way back in 2006, 2007 onwards. I think what has happened is since both the entities, whether it is a developer or whether it is a private equity fund, have gone through a certain learning curve, and as my friend said, that there would be obviously developers who are able to attract capital, who had returned capital in the past. I think that underlying situation will always play in the mind of the investor, and that's going to be there.
Shraddha, Reliance is very active in this market, so I'm sure you've invested in a number of cities, different types of projects. What's your take on the market?
At this point, all across the market is in stress. I think the stress varies. To some places, in some micro markets, it's far greater. In some micro market, it's lower, but it's generally pretty high. Probably geographically, I think it was covered, but probably the worst is Gurgaon, NCR, other markets, different shades of bad. The primary issue, and there is of course a dichotomy here, and I'll come to that in a minute, but the primary issue here to my mind is an issue of credibility. right? When you look at what's happening, and when you look, let's break this up and look at a few more data points. When you look at mortgage sales, and this is mortgage data which is available from RBI, so you can Google it and see it. It shows that month-on-month growth of mortgages has been in the vicinity of 16%, which would suggest that there are obviously people buying houses because they're taking mortgage loans. Right? So that's good. But at the same time, I think what's very clear is that the investment demand has come off. One of the reasons why the investment demand may have come off is, or a few reasons why it may have come off is, a lot of people invested in 2012, 2013 in a lot of projects which haven't seen the light of the day. So maybe you're waiting to actually see some of that, because it's like before मैं और पैसे लगाऊं, देखो boss ये बना नहीं बना, कब से बन रहा है, कब होगा मेरा, so to speak. Also, you had other asset classes which are more attractive. You had a great run in equity. Ignore what's happening in the last few days. But if you look at what happened about a year ago, the equity market and the debt market made for, or the public equities and debt market, made for a fairly compelling investment opportunity. So a lot of money went out there. So net, when you look at it, there's been clearly less absorption, but I suspect that a lot of it is from the investment side. Clearly, I think what Saurabh said and he described as operational efficiency is, which is perfect. The other way of saying it is, जो building बना सकता है, जो building deliver कर सकता है, और जो बेच सकता है, so to speak. That guy is still managing. I'm not saying he's rocking, but he's managing. For all others who were more, selling on basis of more brochure, या काम हो जाएगा, we take our time, that's not working any longer. The paradigm has changed. If you look at it socially too, or if you look from a, from a sociological point of view, people are looking for delivery. Whether it is a developer, whether it is a political party, people want guys who can deliver. And, obviously people are gravitating towards that. I don't believe there's any shortage of money in the market, not whatsoever. It is the issue of credibility. I'll just make 2 points here. NCR or Gurgaon, which is possibly the worst market, the largest developer today on an incremental sales basis, if I'm not mistaken, is Godrej, right? A guy who didn't play in that market some time back. And it simply tells you that people are buying credibility. That's what they're seeking. Similarly, you've seen guys gravitate towards larger names, but that comes more from a perspective of credibility. The last thing which I'd like to add here, and that's more from a perspective of, a silver lining for all of us, because, at the same time, while at one breath I'm saying the market is bad, and depending upon each micro market, it would take 9 months to maybe even 3 years to recover, even that long. But even if you look at it, I think one great thing which is there is that the end user is not in stress. Other than maybe some parts of, North India, we primarily operate in 5 markets, so I'm talking primarily NCR. Other than that, you look in most of the markets, I don't think the actual end user, which is a buyer like you or me or somebody out there, is really in stress, which is great, which it really means that the issues are if you have certain things fall right, and that's possibly more to do with, people actually getting delivery of what they were promised. That's the most important. Or in other words, credibility. You'd actually see the demand coming back reasonably well. It's not a shortage of money, or it's not something which is fundamentally structural. I think people need to see, delivery, action, and commitment on the promises.
Vikas, you want to add your take on the overall market fundamentals?
I think I don't have anything to add. I agree with what Shehzad is saying.
Kalyan, you want to add the market?
No, I guess almost everybody has said everything. I just want to probably in a lighter vein say that while we are going through a cyclical downturn, and unfortunately none of us have the title to a crystal ball which we can gaze into and predict as to when exactly is it turning around. I would hope that in the next, 12 to 24 months, somewhere it will start turning around a little bit. But mankind is not in danger, and real estate has survived so many years, so this will survive as well. So the stronger-hearted people will survive this. Focus on the right things, deliver, keep your promises, stay cheerful, focus on your health. Those kind of things developers could do. These are bad times where you can probably focus on your health so that when the good times come, you start selling more, you at least have a strong heart to deal with it.
Last year around the same panel, there were like 7 panelists, and asked this question, tell me one fund who's given returns back to their investors. And all my panelists were kind of struggling to kind of come out with a name. All 7 of them, kind of Shehzad was also on the panel. But I told them they can't name themselves. So we were all struggling for like 3-4 minutes. There was like silence in the panel. So let me kind of twist it a little bit. I'll start with Vineet. We all have made mistakes. All the fund managers in the last 11 years have made mistakes. Without mentioning names, if there is one mistake you made which at least the other fund managers in the audience and in the panel shouldn't make, what would that be, Vineet? You've been around for a while in India now, so.
I think, a lot of the investments that were made in 06, 07, at least from our standpoint, were made with a view to the public markets, frankly, investing in high quality developers who were, going to go public imminently. Looking back, we knew that real estate is not a public markets business, frankly, anywhere in the world, development in particular. I mean, if you look at the West, you either have real estate companies which are REITs, which effectively own cash flowing assets, or you've got companies which only have land banks, or you've got companies which are only developers but don't own land and buy land only when they want to develop. So, and these three are very different businesses, and when you try and combine them in a public market setup, it's just not easy to value, frankly, and it just doesn't end up becoming a public markets business. So, I mean, in hindsight, I think that, that was a big learning that I think us and a lot of other people took away, that a lot of these companies are inherently harder to value, and if it's harder to value in the private markets, it'll be very hard to value in the public markets. Therefore, I think I would say that.
Shahzad, one mistake you made, which you would advise others not to make?
Okay, we probably made many, but
Just one, without mentioning names of developers.
I would say one of the learnings is something which we're trying to do more of now, not that we're primarily in the structured debt space. So one of the things which we've always done it, but we're trying to do a lot more of now is focus on guys with the ability to deliver operationally, what we were discussing about, because, it's like the critical thing which is differentiating guys, your spreadsheet also throws up the same numbers for everybody, but the critical thing is how a guy can deliver. It's like, balla to mere haath mein bhi hai, Sachin ke haath mein, but what he can do with it is very different from what I can. So you need to pick the right guys who have that ability to, so to speak, deliver. So, focus a lot more on those things which drive, the ability to deliver operational performance, because that in the debt space, which is primarily the space we operate in, is been the differentiator to our mind between some guys who've done very well and some guys who are not doing so well.
Saurabh?
The one mistake or the one learning which I still feel some people will make going forward is strategy drifts. And backing residential developers, doing commercial, hotels, retail, shopping centers, and that's a very different business. And I think that mistake is going to be made again. So that's why I feel that it needs to be repeated. That's a serious mistake to do.
Vikas?
You have to be very judicious when you're doing equity investments, and equity investments you have to do with only with a very few selected players.
You want to add?
It's hard not to sound academic in response to this, but if I were to take away from what we've done, we've learned, just as others said, that I think what we fundamentally bet on is, okay, the underlying execution abilities to sell, etc., may be evaluated by everybody, but effectively the resourcefulness of the developer to be able to manage pretty brutal ecosystem in this country that keeps getting tougher and tougher with every quarter, every month, is something that we value above all else. And so that takes to what Kalyan said in terms of strong heart, ability to breathe, and be able to manage the ecosystem. And second is, from an investor perspective, there is no real play in trying to absolutely maximize your return. So whether you're operating in the equity space or the debt space, there is always a life cycle through which you should expect your investment to exist and crystallize and exit. So if you do get an exit opportunity, exit. And don't try to hold on for that extra 2% IRR because you could land yourself in serious trouble. So these are two things which we've learned over time, just not just in real estate, but otherwise also.
Puneet?
Basically, see, we invested both through debt and equity in the past. And I think the biggest, very unique issue which we faced was that, it's very common to say every market is very different, and beyond a market, every micro market is different. But for example, we invested with a developer from X city who had a project in Y city. So from a Western India developer, we invested in a southern market. In a way, that developer also had an new entry to that. So I think since we all knew, I mean, developer also felt it, we also realized it, that the markets work very differently. But I think somewhere during that execution of the project or building up the team or all those things, we kind of forgot that, there would be a differential, profitability, different way of, the customer psychology which will work. And I think that was a big learning which we had, and in a way developer also had. So we had to kind of re-look at, go back to the drawing board, rethink, have a different team structure, work on the team, operationally manage it better, had to even put some of our team in a manner that who were in a way micromanaging that particular project had to be done, although that particular deal was a debt, structured debt deal.
Kalyan?
So I guess two or three key learnings. One is in the last cycle of investments, while we did bulk of largely structured debt deals only, but the last cycle of investments led to partners or developer partners, when I say that. Their aspirations were scaling much faster than their capabilities or skills, and hence you can never do wrong to yourself by staying close to their organization side as well. So, how is their engineering side working, how is their, site monitoring, project management, even if you have put debt. So it will never serve you bad to behave as if you are an equity investor, even if you have put debt. Otherwise, the developer's competence can come in the way of your debt getting performed appropriately.
Because, let me ask the next question to you. Who are the funds who are kind of succeeding today? Guys who are offering innovative solutions to some of the developers, people who are there at every stage, people who can fund at different risk points. For the audience, where there are a lot of developers also, which are the kind of new products you can think of from the PE industry when they can avail of, rather than run of the mill? Like today, most of it is debt, self-financing, liquidating debt. That market is kind of slowly becoming competitive. Vineet was mentioning earlier on that there's not enough money available for him to kind of lend to that market because the US return expectations are much higher. So what are those products which is going to be helpful for the developers?
See, we believe that any strategy in India is not pretty deep, right? $1 billion or $1.5 billion comes in, that strategy goes for a complete toss. We saw in debt market till 2009, from 2009 to 2012, not much competition. Whoever had capital made money. Then one or two players who come in with decent amount of capital, the returns fall down. The risk which you need to take for even a lower return becomes higher than what you were taking. So we believe that the market is very shallow. You have to be jumping from one bucket to the other bucket, and you have to be pretty nimble about it. And in each bucket which you jump, you must understand the risk and should be in a position to manage those risks and get out. At this point of time, we don't, at least from our standpoint of view, we are not seeing from a risk reward perspective, lending being a great strategy to be in at this point of time. Maybe things will come up in 6 to 9 months. We hope somebody burns their fingers pretty badly, and then we are able to deploy capital after 6 to 9 months. But at this point of time, I think the opportunity which we believe we see is more on the distress side, where there are a lot of developers who are in distress, or a lot of banks who have gone ahead and given money to a lot of developers, and there is a lot of stress there. We believe there are opportunities there where one can play in that market. But then you need to have various instruments. We need to have an asset reconstruction company along with you to go ahead and play. So that's where we see at this point of time the opportunity.
Let me turn it around. Like from a developer point of view, what kind of a solution can you offer them? There's still so much of stress. Everyone has been talking about stress, lack of funding.
No, as long as a developer is willing to give us our return, there is always a solution. So if the returns are there, the solution is always found.
Yeah. Look, I mean, I think people have tried a lot of creative structures, but we look through a lot of them, and they all end up becoming effectively debt, effectively fixed, quasi-fixed return type of structures, right? And there's only so much creativity you can do around that because there are one or two parameters that you fix, right? So I think the next level of financing really here has to come in, where people are willing to step up and take equity risk, and people like us are willing to take equity risk. But I think what has to happen is that the developers have to realize that there's a price today for them diversifying and effectively taking risk off the table, right? Where valuations have to be a lot more reasonable, right? And you know, if the developer's looking to effectively rake in all the upside, right, and try and diversify today, then, you know, so it's, you've got to pick one versus the other, right? And I think over time, as developers, you know, get in further stress, people realize that there is merit in selling today something at a certain price if there's liquidity, right, and continuing to do business. So I think that's where a lot of the next level of financing, next level of thinking, figuring out some of these situations will come up.
Sure, sir.
To the first question which you asked, which was which are the guys who are doing better today, our sense is that over the last few years, if you see the domestic capital, I'm not an expert in offshore capital, but domestic capital is very flexible. And if you've raised money with the appropriate mandate, you have a lot of flexibility around that, which means you can structure it many different ways. So our sense is those guys with, and I'm using the word loosely here, with the more flexible capital, are the guys who've been able to do a little more, maybe than people who come in with more rigid structures or under more rigid framework. These days, of course, which I'm sure everybody is aware, now that offshore, that is AIFs can accept investment from offshore investors, the same is actually true for even offshore investors. So from an offshore investor perspective too, they have the same benefits now that a domestic investor has. So I suspect we might be at a level playing field there. The last thing which you said in terms of innovation, really I'd agree with what Vinit said, which is that, see, at the end of the day, ghoom fir ke, what do you have? You have an underlying asset, you're going to take some sort of a security of that. So you're going to take security of that, and you're going to get the cash flows off that asset, and you're going to use it to pay yourself off. That's the way it's going to be. Now, you may cut it in different ways and keep the money a little more flexible here and there and take it in some in coupon, some upside, and so on and so forth. But net-net, that underlying structure hasn't changed, and I suspect it won't change for the next very many years. So I'm sure equity will come on, but you know, at the end of the day, I would suspect that your lifeblood is still going to be the plain, boring, call it debt or debt plus. So that's debt plus mezz, and I suspect that's the way it will go for the next some time.
Saurabh?
So any strategy from a fund house would depend on the scalability and the profitability. I think these are the two key parameters. And you know, if you look back and see what has happened in the last 10 years, your strategy depended on the regulations. So you had certain rules, and you have to form your strategy around that. And now having those rules gone away and a more liberalized environment, I think things are going to look much better going forward. So that's where the opportunity set gets created. Everybody requires debt, everybody requires mezz, in a capital stack, all these kind of money is required. So you have to see which part of the bucket you want to fill in, which is more scalable, which is more profitable, and what capabilities you want to build around it. I think that's the way people are going to build business. I'm hopeful that next wave of capital will be more sensible and more profitable.
Karthik?
So I think 2-3 questions you asked. I think the one guy that perhaps fits all investment formats maybe is Piramal, I think, in our business. I think he's got such varying pools of capital that I think I've got to put him as the most flexible capital provider into real estate in the country today. Related point was made by Aditya in the earlier panel, where he talked about, frankly speaking, not diversification, but concentration. So I think, you know, investors from our side, and that translates into what builders should expect going forward, are niched into specific strategies. So, and they won't be able to raise money to do everything. So somebody's got to be an expert in something. So I think that plays out in terms of what the builder expectations is. If I'm in this part of the evolution of a project, and this is the kind of capital and the risk that I'm asking somebody to take, I go to this guy or these set of guys. And if I want to do something else, you know, where I need longer term equity requirement, etc., then, you know, there is another set of capital providers who perhaps cater to that opportunity. So I think the market should perhaps over the next decade sophisticate into something like this. But I think it's very difficult from a fundraising capability and a scalability point of view, as Saurabh said, to try and do everything. But on the creativity side, we've often seen that all the deals that have come to us have been, okay, here's the project, and I want to buy land, I want to take out this guy, can you do it at 14%? Right? So all deals that come in at that. So now the creativity is in trying to structure, as Shehzad said, with the developer, what kind of capital goes into what kind of risk and how it generates on a blended basis what return you make to try and meet what Vikas said. So that's our take.
Puneet?
See, I think in the capital stack you have debt, you have mezzanine finance, and you have equity. Now, what happens is you can have a differential return for a shorter period of time. So, for example, a mezz could start giving you equity return, and that has happened, I think, well, was happening probably till the last year or so, or year, or 18 months. But that cannot continue to happen because these are different, pool of capital, and therefore there would be a differential return, has to be a differential return expectation from both sides. When it comes to equity, I think the mindset change. See, one is obviously you could have a lot of things on the paper and start having those things. But having said that, I think the mindset change from both the sides, I would say, developer side to really accept that once there's an equity partner, there would be a lot of asset management play which would actually happen. There would be calls which the investor would like to take when he's an equity player versus probably as a debt player. So I think that really is going to be the big thing. Having said that, I think the going ahead, if I speak to few of my friends besides us who are raising capital, the hybrid structure continue to be somehow the flavor, which essentially means that there would be X coupon on a regular basis, and since there's a larger return expectation, there would be a certain equity kicker which is kind of happening, or expectation of a equity kicker beyond a certain threshold is really the situation which I feel over the next year or so which will happen.
Kalyan?
Yeah. So I think with respect to innovation on the capital stack that you asked, I do not see much of a scope out there. I think the innovation will be more in terms of how you structure the risk allocation between the developer and the investor. Obviously, in the last wave of capital which came into the country, the return on the spreadsheet did not exactly translate into reality because the risk turned out to be much higher. Your approvals did not come in time. The regulatory landscape changed, whether it is a Supreme Court coming in between in a Noida kind of place and coming up with an NGT regulation, or those kind of stuff which you never anticipated, or land acquisition related issues which you never anticipated. Approvals took much longer than you thought on your spreadsheet. So those things started making a difference between what you thought the return will be and what the return turned out to be. As a result, I do see the next wave of capital to be more conservative and the risk allocation to be more favorable towards the investor. On the second question of yours in terms of allocation of capital and what should the strategy one should back, I guess it depends on how hefty you are. Like Karthik said, a Piramal can afford to have 5 different strategies at play, but a smaller fund will probably back 1 or 2 strategies. That will be driven by your comfort, your expertise, and your conviction.
We'll take a couple of audience questions. Anyone from the audience? Any audience? No audience questions, so let me ask you the questions. So what's the outlook, because for next 1 year? That's not even, there's so much of, you open the papers every day morning, people talking about another Lehman in 2016, all kinds of doomsday scenarios, currency, stock markets, China, GDP, American stock markets. Every day there's some bad news about 2016. What's your outlook on your industry?
So, at least from our perspective, we believe that there is pain, at least in the near term, and it will pay us better if we are more patient. So we believe that there would be interesting opportunities which will come out of woodworks from all the suffering which is there in corporate India.
So you would rather not invest, you would?
I'm saying we need to be patient. Obviously, if we get real interesting opportunity at this point of time at 50 cents to $1, we will look at it. But we believe that next 6 to 9 months would be interesting from opportunities which will come out.
Vineet?
I mean, I think this year will be completely driven by what happens outside India, frankly, right? I mean, I think, from an Indian standpoint, we are in a good spot from a macro standpoint, from a fiscal standpoint, with oil being low. So it can't get better than this from our standpoint. But at the same time, you know, real estate purchase is a very consumer sentiment driven kind of a purchase, right? And consumer sentiment over time is influenced by what's happening in the world around, and what's happening in the world around will affect India. So I think this year will really be driven by what's happening outside India.
Shazad, 2016 outlook, your industry.
I actually think it's more optimistic than the past. You know, there's a lot of bad news going on in the world currently, and that's not necessarily bad news for India. I actually think it's good news. So you've got to separate two things. There's a fundamental part of what's happening in the economy, and you've got the separate part, which is the stock market. So all the noise you hear at this point in time comes from more from what's happening from a stock market, which is more from a global funds flow perspective. So can that impact us? Of course it can. But when you look at what's happening from a fundamental perspective, the savings which is happening on account of lower commodity prices, it far, far outweighs anything which is going to happen on the other side. So far, far more. So we are actually, God has been kind, we are in a very, very sweet spot. I think base case for everyone is, in there's so much of pessimism now, that things are going to get, in that sense, better. I'm not suggesting tomorrow morning, but you know, at the end of the day, you can't keep looking at what's happening in here. And real estate is ultimately a domestic business. At the end of the day, the maximum impact is on funds flow from offshore coming into real estate, unlike on your stock market where there's a lot more money which is coming in. So net, I think what's happening out in the world is not necessarily bad for India. Leave the sound bites, leave what's happening in the stock market. It's actually putting more money in Indian consumers' hands, which can't be bad news. You have the seventh pay commission. All of that is incrementally good news, which is coming. So we've started the year on a horrible note, at least as far as sound bites are concerned. Only as far as sound bites are concerned, and hopefully we'll end the year on a lot more positive note than where we started off from.
Saurabh?
Great time to build. You've not seen a situation where costs are below your pro forma. So first time you're seeing savings instead of all the shocks of costs going up. So you're getting pat on your back. So which is a great thing. Second thing is luxury to choose your partner. Whenever you had this kind of a situation where all your whomever you want to do business with is willing to talk to you at your terms and conditions. So I think these are beautiful times to do business.
Karthik?
Okay, I think my colleagues have given all the analytical and logical answers, so I'm going to go out on a limb. I know many people in this room and indeed on the panel will be subscribing, as I do, to this ET newsletter that I get every morning. It covers real estate. Every morning I wake up to a new developer getting arrested or some arrest warrant being issued in his name. So I think it summarizes all what my colleagues said. So it's a great time to give bailout money, bail money, and I think I consequently feel that it's a great time to invest.
Puneet?
Yeah, I think I echo my colleagues' views here. The only thing I would add here is that you would also find, from the fund side, a lot of asset management focus. So what I'm finding, one change is that AMCs which are being centrally done, now they're basically spreading it out in various cities. And I think that is going to be more and more, or the teams of the AMCs being spreading to various cities. I think that's going to be more flavor because there would be more controls and more, involvement, so to say, or engagement in the project going forward.
Yeah, I think the movie of 2015 is going to repeat in 2016 as well. I do not see much of a change. So we'll have to wait.
That we'll wrap up today's panel discussion. I hope the audience got to hear a few new things, learn a few new things from the panelists. Just took a few key takeaways from the panel. Vikas spoke about how fund mostly what's available is still debt. Still, it's only chasing a few developers. That hasn't changed. He confirmed that Kotak made most of the money through investments with medium-sized developers. It was not just backing the big guys. Shehzad mentioned there's a lot more money available than ever before. He said that AF funds which have been raised, less than 50% is actually deployed. There's still so much money still uninvested. Kalyan spoke about how everyone looking for money won't get money. Only good quality projects will get money. Vineet spoke about not able to meet return threshold due to competition. So global funds have a certain return expectations given the country risk and currency risk. So he's not able to meet that. Karthik spoke about how underlying credit quality is same for most developers. Difference is only the execution track record. Saurabh spoke many points. He said, don't paint the entire market with one brush. NCR and Mumbai residential is definitely so slow. Residential has to become a push product than a pull product. So more new methods of selling, more innovative marketing techniques and operational efficiency. Developers who have that are doing well. Top 10 developers list keeps changing every 10 years. That was an interesting point Saurabh mentioned. Resi getting converted into commercial, that was worrisome for Saurabh. Is it the same herd mentality coming back? Puneet spoke about how sales absorption is still a challenge in the market and how the market has matured in the last 10 years, which is good news. Shahzad again spoke about how there is all-round stress. NCR is the worst hit. Primary issue is still is a big credibility factor. Mortgage market 16% growth rate is still good for the market. People buying credibility, he gave the example of how Godrej in the last 3 years has become one of the biggest developers of NCR. So they were not even there in that market 3 years back. End users not in stress, so that's some good news. In terms of mistakes they made, which they wouldn't repeat, don't depend on exit through public markets. Vineet mentioned that, so that was the dream back in between 6 and 8. That didn't happen. Focus more on operational delivery. That should be one of the focus areas. Don't back developers where there is strategy shifts. Saurabh mentioned that. Equity, only the best give money only to the best is what Vikas said. Resourcefulness of the developer and his ability to manage the entire ecosystem is what one should look at. Karthik mentioned that. That was not looked back in 2007 and 8. Puneet spoke about how one needs to focus on the core competency of a developer. Kalyan also spoke about how the aspirations should be in line with capability. It cannot be far superior from the capability. In terms of new products, every opportunity in India is only a few $1 billion. Vikas felt that there's not too much of depth. It's a little shallow there to go lend billions of dollars on a particular opportunities. He said, as long as you give my money back, I'll give you any solution. That's important. Vineet spoke about how valuations need to be realistic for equity. Shahzad also spoke about how domestic capital is more flexible than offshore capital. Saurabh also spoke about how identifying which bucket is scalable is important. You can't invest in all the buckets. Also, risk in spreadsheet different from risk in real life. In terms of 2016 outlook, pain, there is going to be pain in the near term. Patience will pay. That's what Vikas felt. Year is going to be driven by what's happening outside the country, not just what's happening in the country. Shahzad had a different take on it. He said bad news for outside could be good news for India because India could become a better destination for investments. Luxury to choose partner. Saurabh said he's never had this luxury ever before. And Puneet mentioned how this is very similar to 2015. We're not going to see any big changes. And last but not the least, I think Karthik said this is a good time to give bail money as an innovative product to developers. So with that, we come to an end of this panel. I hope the audience got to learn a few things. Thank you very much.
Thank you very much. May I request Mr. Ramesh Nair to please present mementos to our panelists, beginning first with Mr. Vineet Seksaria, Mr. Shahzad Madan, Mr. Saurabh Jain, Mr. Vikas Chimakurti, Mr. Karthik Atreya, Mr. Puneet Bhatia, and Mr. Kalyan Chakrabarti. May I request Mr. Puneet Bhatia to please present a memento to Mr. Ramesh Nair. Thank you very much. Thank you, gentlemen. You're free to go now. No bail necessary here.